Hi, my name is George Dagnino. I'm the editor of the Peter Dack Portfolio Strategy Management. This is a review of current trends in the business cycle and its impact on commodities, interest rates, and the U.S. and global financial markets. This slide shows the business cycle as we computed every second from strictly market data, no economic data. The reason I'm showing it to you because I will use it later on, and you will be surprised by how interesting the relationships are with other markets. Anyway, this shows the economy, reflects the economy strengthening from 2020 to 2021, and then it came down, warning us that the economy was going to slow down and therefore acting accordingly. This chart is very interesting because it shows two things. One, the red line, which means working hours have been declining. So manufacturing is fully aware that something is wrong and is cutting working hours before laying off people. The other one is that the average hourly earnings, which is the blue line, is negative. In other words, in the last 12 months, people in the production floor, they'll be making less money. So what all this stimulus that created all this income is now inflation is taking it away and people are making less money than pre-stimulus. What happened to people working in the manufacturing sector? It happened also for the overall population. This is the income after inflation and after all this stimulus and printing money and so on. Right now, income is deeply negative after inflation, much lower than 12 months ago. So people are hurting because they are not making any money. Income is down 3.9% in the last 12 months. Of course, rising inflation, reduction in income, the population optimism, consumer sentiment is sinking, has been slightly trading in this range here, but it basically has collapsed, showing quite obviously how people are really hurting. What has been happening for consumers is also happening for small businesses. This is their optimism index, and as you can see, has declined quite sharply because people don't buy and they don't make money and things are really bad out there. Of course, when people make less money after inflation, they buy fewer cars. It's happening here, it's happening here, and it's happening here. And every time auto sales drop sharply, a recession is imminent. The housing sector is not immune from the overall weakness, and this is the optimism index, which the HMI, which represents a survey of home builders and how they feel about the housing sector, and they're really feeling pretty bad. Now, why is this important? Because if you compare it to the stock market, which is the green line, every time the housing sector is disappointing, what you see is a bear market of some proportion goes underway. So this is no exception. The index of leading indicators published by the conference board shows quite a dramatic slowdown, and usually when this kind of decline is underway, it's quite likely that you can see a green area, which means a shaded area, which means there is a recession coming. So this is really reflecting an overall trend coming down. One more thing, notice how this leading indicator, the trend shows 3 business cycles that correspond exactly to the first chart that I showed you before that we compute from market data. But I'll show you more stuff that seems very, very interesting to me. Of course, the commodities, copper, lumber, crude oil, and by the way, I put soybeans because people say prices of soybeans depend on the weather. But what I wanted to show that when the economy, as shown in the business cycle, it strengthens, then you see all commodities rising, all commodities rising, from copper, lumber, crude oil, everything, even soybeans. But when the economy started slowing down from the middle of 2021, as I showed you before, all the commodities weakened, reflecting slower economic conditions. What is the trend in the next several months? Down. Why? Because these are the red line is inventories, wholesalers' inventories after inflation. All the data are after inflation. And the blue line is sales. Now, when sales fall below inventories, the growth in sales falls below inventories, you know that business has to cut inventories, because otherwise they're going to start losing money. And because they have to sell inventories by cutting prices and cutting production. This is two things the business doesn't want to do. Now, what is happening now? Well, as you can see, as everything is coming down, right? So you're not surprised that sales are slowing down. But the point is that sales have been slowing down at a pace lower than inventories. So business is going to react by cutting production and cutting prices to get rid of this excess inventories that is hitting their profitability. This is inflation at the consumer level and at the commodity levels and at the finished goods level. Notice how this trends reflects exactly the business cycles that I showed you on the first overheads. And look what happens now with the curve coming down and commodities coming down and sales coming down and production coming down. You'll see that this trend is likely to continue down. What about interest rates? Well, this graph shows the red line is the yields on the 10-year bonds, and the blue line is the yield on the 2-year notes. This chart shows something quite interesting. By the way, the shaded areas are recessions. This chart shows that when short-term rates rise, eventually they start kissing the 10-year bond yields, inevitably. And this is what's happening now. But the interesting thing about this chart is that when this happens, the odds are that interest rates are going to decline. And this is the first notice. So the odds from here, what this chart is saying, that the interest rates are much, much closer to a top than at the bottom. This chart shows why all this is happening, what has happened and what will happen. This is the yield curve. The yield curve is computed subtracting from the 10-year yields the 2-year notes. So it's 10 minus 2. The red line is liquidity. This is very crucial and important. The reason we have a strong economy growing at 35% GDP, and we have huge inflation, because look at this jump in liquidity caused by government spending and Federal Reserve assistance to the stimulus provided by the government. However, look what happens after 2021. Remember my business cycle indicator at the beginning? Liquidity has been taken out of the system quite aggressively, the red line. And look at what happened to the yield curve, steepening. When these two lines steepen, means the economy is heading in a pretty sharp contraction. This is something, everything that is happening is because this has happened from 2021. Let me show you something else. This chart is very, very interesting. This is the yield curve, which is a 10 minus 2 yields, and this is flattening and inverting, steepening, flattening and inverting, steepening and flattening and inverting. This is the percentage of banks tightening credit standards. So the fact that I flipped is inverted the curve. And what this thing is showing, that the number of banks tightening lending standards are increasing. They have been increasing here. They've been increasing here. And yes, banks have been tightening. More and more banks have been tightening lending standards. Now, this is bad news. Why? Because it takes the yield curve to steepen for several months before banks start easing lending standards. So we are now in a period where we have a steepened, an inverted yield curve with banks now tightening lending standards for some time because they will keep on tightening until this thing turns around and goes up, which will take months and months. So we are in a weakening economy with banks that will keep increasingly tightening lending standards. And that doesn't spell good news, quite frankly. This is an interesting chart, also very useful actually. It relates the trends of the stock market, the red curve, with the yield curve. This is the yield curve, inverted, steepening, flattening, inverted, steepening, flattening, inverted, and so on. What is interesting is people usually relate the inversion of the yield curve here, 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 and here, and here to the recessions, which is the shaded area. What I think is more useful is to relate the shape of the yield curve to the bottom of a bear market. Let's see what happens at the end of the bear market. At the end of the bear market here, for instance, the yield curve is, as you can see, the scale says 200. So it's 2 percentage points different between the 10 and the 2-year yields. This is the bottom of the bear market. The yield curve is steep enough, and the difference between the 10 and the 2 is another 2 percentage points. Here the bear markets ended and the yield curve is 1 percentage point difference between the 10 and the 2. Here the bear market ended and here is another 1 percentage point difference, positive difference between the 10 and the 2-year yield. So what is the point? The point is that the bear market ends after the yield curve steepens and the difference between the 10 and the 2 has at least, say, 50 basis points to 100 basis points. So that is half a percentage point to 1 percentage point. So how do we apply this to the current situation? This is a bear market. When will the bear market end? The bear market will end when the yield curve, which is now inverted, eventually steepens. When, we don't know, but eventually steepens, and the difference between the 10 and the 2 is around 1 percentage points. So there is time for this to happen, because even if it starts inverting now, as you can see, it takes at least roughly at least 6 months before the difference reaches this point here until it reaches this point here. So we should expect the bear market to continue for a while. I told you to remember this chart that I showed you the first slide of this review, and we said this is the business cycle as we computed using market data every second, basically. And what it shows that the business cycle rose, reflecting strong economy, and beginning in mid 2021, it started going down. And in fact, we saw in the previous slides that everything we see, from money supply to yield curve, income, commodities, everything is started going down. And possibly now this curve will also be followed by lower inflation. Let's now remember this chart and let's see what happens in the international markets. These data are published by the OECD, which is an international organization publishing international data from the economy, growth in the economy, inflation, employment, and everything else. And one of the things that they publish is the global business cycle. And as you can see, the global business cycle has turning points that look awfully close to the chart I showed you before. Now, these are computed from economic data. The chart that I showed you before is computed from market data. It does not have anything to do with the data used by the OECD. Now, the US, as the business cycle, as computed by the OECD, has the same turning points that has the global business cycle. China has the same turning point of the global business cycle and of the United States. The euro area has exactly the same turning points of the global business cycle of the US and China. I could have shown you other countries, and they all have the same turning points. What is the point? The point is that when you see one country is behaving better than others, well, maybe it's probably relative to strength, but it's not that one country is stronger and another country is going down, because all the countries have their economies moving in the same direction. Is it just a matter of the only difference is relative growth, but the major turning points, all the countries have the same turning points. Something to remember, because now we're going to see what the stock markets are doing. This chart shows the stock markets of the major economic areas on the planet. This is the global stock market ex-US. This is the stock market in the US. This is China, and this is Europe. And what you see is they all have the same turning points, the same turning points of the same data of the charts that I showed you before. The same thing with China, the same thing with Europe, the same thing with US. Same thing, a little smoother, but you see the same turning points. So what is the point of this? Is that all the economies have the same turn up and down at the same time. All the stock markets turn rise and decline at the same time. So when one talks about investing overseas, only invest in relative strength, not because hedging means that one country goes up and the other country goes down. That's hedging. You cannot hedge in the foreign markets because they all move in the same directions, up or down. Why? Because they all follow the same global business cycles that goes up or down at the same time. And this means that profits, the profitability of the corporations in each country, rise and decline all at the same time. Well, I hope you enjoyed my presentation. I wish you a great day, and I hope to see you really, really soon. So long.